We're now asking Mike and Morris and Arvind to come up. The floor is open for questions. I would suggest that people recognize that those who didn't have tables do have a microphone, and those who have tables don't have a microphone but will hear you somehow. Oh, we have a floating microphone. And so please identify yourself, and I'll call on you. The gentleman right there. Head back to the mic right behind you.
Right here.
Actually, this is a good excuse to point out we now record all our events and put them on the website. So yes, please do go to the mic.
Hi, thank you very much. My name is Hung Tran from the Institute of International Finance. Mike Mussa took exception to the nonsense being mentioned by many commentators. And in that spirit, I would like to clarify a confusion when many commentators mention estimates of credit losses, $300 billion here, $600 billion there, and so on and so forth. When we talk about loss, we have to be clear what is it that we refer to. If you look at major banks and brokers internationally since the beginning of last year, they have reported up to $235 billion of write-downs. Of that amount, about $26 billion were credit losses. The remainder, which is about $210 billion, represent mark-to-market losses. Now, mark-to-market losses, the way it has been calculated, leaves a lot of questions to be asked. And the way it is calculated, to a large extent, since it represents holding of CDOs, it is based on a very flimsy index, the so-called APX index, which has been coming down significantly in the past 9 months. But since that index, the way it is traded, is very driven by investor sentiment, there's no reason to exclude the chance that it can go up significantly if sentiment were to change, as it will at some point in the future. So in the past, we see large write-down. In the future, at some point, we cannot exclude the fact that we can see large write-back by banks as well. And therefore, at the end of the day, the real economic losses for banks and securities companies, it's not clear what that amount will be. Definitely less than the whole big picture big numbers that we have heard. Significant still, but we should be careful when we refer to the loss.
That actually is something more Morris's alley, and I'm just wondering if he has anything on the mark-to-market, too much or too little.
Well, I think the point made is a good one. I mean, you have all these estimates out there. Some are before loan loss reserves, some are after, some could be higher and lower. I think there is a very wide margin of error surrounding those things, and in some cases, you are comparing apples and oranges. Whether in the end the figures will turn out to be much smaller than a lot of those that are being bandied about, I don't know, because on the one side, to get to the big numbers, you need asset classes beyond mortgages to go down. For example, there haven't been very large losses in commercial real estate yet, but if those go bad, then you get much bigger numbers. It could be that you'll get less of a loss on some of the subprime things and some of the CDOs, but it depends, how much of this migrates into other areas of the balance sheet.
Okay, great. Please identify yourself.
Thank you. Stephen Collins with the Automotive Trade Policy Council. My question is for Mike, but also the other panelists if they'd like to comment. We've attended seminars here in the last year where we've talked a lot about the ongoing reforms and restructure or success failure of the Bretton Woods framework institutions. We have the Doha round, which may proceed or not proceed in the next several months. We've had just a session here within the last month on the whole reform process of the IMF. We have the IMF meeting and the G7 coming up. questions about whether there, global G7 interventions, coordinated interventions could have an effect on the global economy. My question is really, what is your assessment with this situation we're facing globally and here about the ability of our global institutions to affect, in this situation, the conditions and the outcome as it plays out over the next several months or a year?
Well, if we're talking about the next year or so, then I think that the contribution we should expect from the global institutions is probably pretty much limited. I mean, we are talking about the macroeconomy, and then it's largely monetary and fiscal policy, which is going to rule the roost. And even in areas like intervention policy, it's not the IMF that decides those things. It's the major countries that will make those decisions, or the IMF can provide advice. So I'm not looking for much help there. A big IMF loan to the U.S. is not, I think, likely to be part of the solution. Now, a number of the issues that Morris raised, as he indicated, are issues not only for the United States, but for other countries. And since we have financial institutions and markets that operate very actively across national boundaries, some coordination of the approach that's taken to these reform issues is clearly going to be important. And the international financial institutions, I think, have an important role to play in that regard.
Barry Wood, Voice of America. Mike, I'm still trying to come to terms with how a significant slowdown is good for us. But could you give us your outlook on inflation, given your forecast, and given the slowdown we've already had, is the continuing increase in commodity prices, particularly oil staying where it is that a bubble, a speculative bubble, or is that result of demand in Asia?
Well, there's very likely some speculative component in recent energy price increases. This is not an area where I'm really an expert. We have some people here who are more expert about it than I am. But in order for speculation to be a key driving feature of the price increases we've seen in the broad over recent years, I think we'd have to be seeing inventories rise. That is, what's been happening is final demand has been growing quite rapidly in many of these areas versus supplies that have, underlying supply has been much more difficult to advance. So if speculators were buying up stocks and holding them, then I would see that as an important driving feature of prices. But in the energy market, that is not predominantly what has been happening. Stocks are very small relative to annual consumption and production flows, and what has been happening is that world demand for actual use has been rising more rapidly than it's been convenient to expand supply at a given price, and that's been pushing the price up. And I think the same is broadly true across a wide range of other markets. Now, you think about a commodity like gold, well, I mean, there holding stocks is part of the essence of what's going on. So I think that's a little bit different. But you can't run that story in wheat and corn and steel and cement and all the rest of it. There, I think the story has to be that the demand growth has been very rapid. And the demand growth that has particularly mattered has been demand growth from these rapidly growing emerging market countries that use, relative to the dollar size of their GDP, a lot of these primary products in their GDP production. That's why I say I think we need now a slowdown of global growth in order to take the edge off of commodity prices. If we get a crash, of course, of global growth, then as we saw in the 70s and the 80s and the 50s, we could get a considerable crash of commodity prices as well. So if global growth falls to 2%, which would be a worldwide recession, then I think we would see a significant weakening of commodity prices. But at around 4 or a little less, I see that we'll take the edge off, but I doubt that we'll see a collapse.
Luckily enough, Dan Jurgen happens to be next in line to ask a question.
Not a
But you
comment.
could also add a comment if you like.
Okay, well, thank you. I think that I think it's a lot. What's happened to energy prices over the last 8 months has a lot to do with the things you've been talking about. What's happened to the financial markets, interest rates, and the dollar. But my question is really the flip side of that question, and for Michael and I guess for Arvind, to turn it around. Does it make any difference to your forecast whether oil is $70 a barrel as it was last summer, or $110 or $115 a barrel?
Yeah, I think I mean, the problem is, why does oil go to $70 a barrel? If it goes to $70 a barrel because growth slows down, well, then it's obvious it's slow growth that does it. If supply were to pick up and that were to be the source of the decline in oil price, then that would be a positive feature for growth. I mean, part of the reason why I think the U.S. growth is slowing, particularly on the consumer spending side, is we are seeing some impact from higher energy prices and higher food prices as well, which are cutting into the real income of U.S. consumers. And the depreciation of the dollar is adding some amount to that, because these are all products that are priced in world markets, and when the dollar goes down against other major currencies, the price to us of many of these things goes up. And as I say, I think that that's contributing to the slowdown in the U.S. And, you know, the forecast would be a quarter point higher, perhaps, if the oil price was more like 80 than 100.
Gentleman back.
Thank you. My name is Andrei Lushin, and I work at the IMF. I have the following question. The current stance of the U.S. macroeconomic policies is well understandable from the point of view of domestic U.S. situation, that is radical monetary easing and fiscal stimulation in order to prevent a recession and to help the struggling financial sector. But there is also an international dimension of this policy, because it undermines further the US dollar, and at some point the foreign investors may become less willing to acquire the US assets, and in this way to finance the still sizable the US current account deficit. If by that time the US current account deficit, which is now improving, but if by that time it will still remain sizable, it is then that the real problems may occur, because the interest rates will increase, and it is then the real crisis may happen. What do you think about this?
Well, we sometimes call this the dollar crash scenario, and Fred is a great advocate, at least, of the risk of this type of thing happening. And I think there is some risk if foreign investors suddenly decide that holding U.S. assets is no longer attractive, and even if they said holding more U.S. assets isn't attractive and cut off the flow, then we would likely see the dollar sink rapidly, and that would, in that situation, put upward pressure on capital costs in the United States. Now, I emphasize that is not what we have seen so far. That spreads have risen for private credit market instruments denominated in dollars, while Treasury yields have fallen very substantially. Some people say, you know, well, U.S. agency mortgage-backed obligations have crashed. Not so. They've gone up in price, not down. What's happened is the spread between them and the Treasuries has gone up. And as far as the dollar is concerned, I think probably the driving force has been that U.S. interest rates, short-term and long-term, have come down, and that has made holding dollar assets less attractive, and as a consequence, the price has adjusted to make it cheaper for foreigners to buy in terms of their own currency, the same amount of assets denominated in dollars. I think probably it's been the yen has been the most affected because the yen was kept at very, very low levels. Last summer, you may recall, it was at 123.5 against the dollar and 167 against the euro, which was extraordinarily weak. But that's the Japanese maintaining a 0.5 percentage point short-term interest rate. Now, as the U.S. interest rate has come down much closer to the Japanese rate, that's been an important factor pushing the dollar up, pushing the dollar down against the yen. Now, the financial market frivolities have probably had some role in that also, though the data on the famous yen carry trade is kind of hard to come by. There probably has been some retrenchment of those who were involved in that trade as the differential between U.S. and Japanese rates has narrowed. So yes, I think there is some risk that that could happen. I don't think that that's what we've seen up to this point. Accordingly, I think the Federal Reserve has basically ignored any impact that its policy easing has had on the foreign exchange rate of the dollar. I think not different than the attitude that other central banks, big central banks at least, often take towards the exchange rate.
Let me just add one note. One on-key note to what Mike was saying. We're about to release a short note done by Ted Truman and Doug Dawson, who work here, on analyzing the latest IMF COFR data, the data on international reserves, and through the fourth quarter of last year, that doesn't show any major shift of global reserves out of the dollar in any significant way. There's been a decline in the holdings of official reserves in dollars because the value of them has gone down. But as a number of researchers, including some of your colleagues at the fund, but also Ted working here, myself, and others have worked on, we show that basically official reserve holders are portfolio rebalancers. So they've been actually, at the margin, buying more than to compensate for the decline in the dollar in terms of their reserves. On the official sector, again, you're seeing a lot on the potential for the euro displacing dollar, which would presumably be one possible effect of the kind of dollar disaster scenario Mike was mentioning. We're not really seeing that, even just slow accumulation of long-run trends there, not much of an acceleration. The point I would make for those of you who have been here at our past meetings is that Mike Mussa deserves credit, as do some counterparts at the Federal Reserve a little later in the process, starting to warn a couple years ago that the rate of productivity growth and the rate of labor force growth in the U.S. were slowing down. And so when Mike talks about there being a relatively sluggish return to growth, even though we're not suggesting a very deep, long recession, that in part is because the trend rate of growth in the U.S. is likely to be slower for the next few years than it was in the preceding few years. And much more than worry about the dollar crash scenario, I think most of us are much more worried that the termites are finally coming home to roost. People kept saying, why do you care about all the debt the U.S. raised? Why do you care about the consumption boom? And while people would talk on the one hand about the risk of crisis, many of us in this building, perhaps ad nauseum, kept saying it's a termites problem. It means we're diverting resources into non-productive investment. We're going to have to pay it back someday. There are distortions in the economy. And that seems to be the scenario that we're looking at, which of course also affects the inflation outlook if you think potential growth is slower and you've still got inflationary pressures. So not to deny the scenario you're out there, but I think it's important to keep in mind the main scenario is actually not pretty, just not very dramatic. Arthur, you were next.
Thank you. Arthur Alexander at Georgetown University. There was an interesting point raised here that with the global excess demand, the burden of adjusting to that demand is being distributed pretty unequally. The United States, as everyone suggests, is not doing it for obvious reasons. we are increasing, we're stimulating. Asia doesn't seem to be doing it, and this seems to leave the Europeans, Canada, and Mexico on the short end of the stick. And are we going to be getting the political complaints? Here, reducing global demand is a public good that nobody would want to go up and do themselves, and is being assigned to Europe and Canada and Mexico by default. Is that a correct way to look at this?
I don't think I'd put it quite that way. I mean, the U.S. policy is attempting to stimulate the economy because otherwise it would be too weak. So, I mean, my forecast is that with all the easing, nevertheless, we're going to get year over year barely more than 1% growth, and fourth quarter to fourth quarter barely more than zero growth, as I say, despite all of the easing. Now, of course, there's some countries that will complain that, well, your trade balance is improving, and that's, sucking demand out of our economies. And, of course, that's true. But on the other hand, for most of the past 15 years, things have been working the other way, and now we're getting the sort of reverse of that, and the U.S. needs to correct a very large external deficit, and a key component of correcting that is getting our domestic spending growth down below our actual income growth, and stimulating our net exports, and the weaker dollar is helping to achieve that result. A problem comes, as was suggested earlier, if too much happens too fast in terms of the depreciation of the dollar, also in terms of the slowing of domestic demand. Say we write down the value of homes in the U.S. in real terms by $5 trillion. Not a small figure, not an enormous one. People spend 5 or 6% out of each dollar of wealth, so we're talking about $250 to $300 billion annual consumer spending relative to trend. If that comes all in a single year, we're going to have a monumental recession. If it's spread out fairly evenly over 4 or 5 years, then it's going to be a desirable slowing of the growth rate of domestic demand in the United States, which is a necessary counterpart of reducing the U.S. external deficit. So when I say I'm hoping for a recession, well, I'm hoping for a mild recession, right? Not a humdinger.
Thank you, Jim Harmon. To what do you attribute the fact that U.S. equity prices have declined significantly less than European and Japanese and India and China and so forth? A good deal less than 50% of the decline. Do I give some credit to that? If you take the Dow Jones or the S&P 500, it's down 7.5%, shall we say. Europe and Asia, or Japan specifically, are down in the high teens. To what do I attribute that? Do I give credit to the Federal Reserve action or the government action? Do I give credit to the dollar decline? Do you have any opinion?
Well, we need to remember that, typically speaking, the U.S. market has, relative to the world market, a beta of less than 1. That is to say, it fluctuates less per unit fluctuation in the world market, and European markets, the Japanese market, and particularly emerging markets, have betas above 1, and for the emerging markets, in most cases, really big betas. It also depends whether we're measuring from year end or we measure from last September or exactly what. I think part of what has happened is that the policy response in the United States to reduce U.S. interest rates, and hence the rate at which investors capitalize income streams denominated in dollars, that has gone down, and that tends to elevate asset prices. We've had much less interest rate reduction in foreign markets, so presumably the discount rates at which earnings in those markets are discounted has not been reduced as much, and I think that's probably part of the explanation. And of course, the leading explanation of this phenomenon is, as always, particularly with asset prices, we don't know what the hell is happening.
Okay. I have Michael and Mary Jo and then Mustafa. Michael first.
I'm Michael Johnston from the Capital Group in New York. My question is about reform and regulation. Every time we get into a situation where things like this happen, we decide that we're going to reform based on whatever the crisis that we've just been through is. And I'm a little concerned that we are accepting the structure of the industry and designing the various reform measures. And by that, what I mean is that Glass-Steagall is relatively new in its abeyance, and that with banks and investment banks and brokerage firms and so forth now allowed to compete one with the other and have multiple parts to them, I've not yet seen any calls for us to go back to a Glass-Steagall structure, even though obviously that would make the oversight and regulation somewhat easier. In other words, those who regulate the banks wouldn't have to worry about the investment side of the investment bank and so on and so forth. And I can think of a lot of other crises that we need to watch for that could come up into the financial system that are not somehow liquidity or credit related, and therefore oversight of a certain expertise on the given actions of a financial institution would be very important. In other words, an expert in the banks is the best regulator of banks and a regulator of brokerage firms. Is there any reason that we should think about, again, somehow parsing the parts of our financial system so that we no longer have a commercial bank owning an investment bank owning a brokerage firm, et cetera? Or are we stuck with the structure of the industry as it now is?
Well, I haven't heard very many calls for trying to go back to Glass-Steagall and separate those things. I'm certainly not suggesting that. If you look at the Treasury blueprint, they reject that. Their model, what they call the ideal model or the optimal model, is one where you have separation based on the objectives of regulation. Safety and soundness is one, market stability is another one, and business and consumer protection conduct is another one. So I don't think that will happen, and it's certainly true that every crisis will be different. But I think there are some issues that will have legs. And I think one of the big ones that I tried to indicate in my presentation is I think we have to think about whether we want to go to a system where we have higher liquidity and capital requirements. That will mean that the financial sector doesn't go as fast. It won't have as much leverage. It'll probably be less profitable, but that will probably bring with it lower risk of crisis. And that's something that we have to decide. So far, people haven't been willing to do that. They say, no, let's kind of let her rip. Every once in a while, we'll have a crisis, but it won't be very deep, won't last very long. And so, when we compare the costs and benefits over a long period, it's still better to have a kind of light touch, not to go far in trying to be more cautious. The problem is, however, if you get a big one, then when you do that comparison of cost and benefits, it's not the case. So I think, in a way, the prospects for reform depend in good measure in how bad it gets. If we get out of this one, with another quarter of negative growth or so, and things come back, and my guess is much of this talk about real regulatory overhaul will go away. If it turns out that this crisis turns out to have bigger effects on the real economy and lasts a while, then people will say, well, really need to do some thinking and do some major rejiggering of the architecture.
We're getting closer to our witching hour. We have 10 minutes left. I'm going to ask, there's a question over here and then Mustafa here, and then we'll see where we are on timing depending on the fascinating replies of my colleagues.
Thank you. I'm Jo Marie Griesgraber with New Rules for Global Finance. I can't move my chair there. Okay. I just wanted to get back to an earlier question of Michael Mussa, and that was, it's a good thing for the U.S. to have a recession. And we've looked mainly at the level of analysis between countries and a lot of macro analysis, and I'd like to look more on the impact on human beings. And which sectors of the economy do you recommend should receive the brunt of this recession? Who would it be good to have their consumption be reduced?
Well, of course, we have been seeing a very substantial reduction in residential investment. I mean, new home building is, as of today, half of what it was at the peak at the end of 2005, beginning of 2006. And there's probably some more to go in that regard. But the issue of whether we now, in some sense, need a recession is, given the amount of easing that we've seen by the Federal Reserve, the fiscal package will come and go, so we don't need to worry too much about that. But the Federal Reserve has eased from 5 1/4 down to 2 1/4, and I believe if we get weak economic data over the next 2-3 months, they're going to ease another 50 to 100 basis points. And they're not going to tighten so long as significant stress remains in financial markets. They're locked in to a very easy monetary policy through the end of the year at least. Suppose now that we don't have a recession, suppose macroeconomic advisors is right, we're barely positive this quarter, we pop up to 1.5% to 2% growth. This quarter, we're barely positive last quarter. We go up to 4 or 5% in the third quarter and then back down to 3 or so with 3% growth next year. Well, I think then, with such an easy monetary policy, we are going to see the inflation rate take off. And the Federal Reserve is not going to be in a position to contain that. And then at some point a little bit further down the road, they're going to have to deal with that problem. And in the past, when we've had to confront that type of situation, that's when we've got a real humdinger of a recession. So if my forecast is right, that we have a recession or near recession, then I think the optimism that the Fed has expressed that inflation will come down from a level that is already regarded as a bit too high is reasonably well taken. But if we're not getting that slowdown, then I think we're going to have much more of an inflation problem. And there are going to be a lot of people who are going to pay the price for that. You need to remember what happened in the 81-82 recession and the 74-75 recession. We don't want to go back to that. More generally, I mean, as Arvind was indicating, particularly for Asia, in the world as a whole, we have a bit of an inflation problem. We need to have slower growth globally if we're going to take the edge off of that. That's why, although my forecast of global growth is, I think, now essentially no different than the IMF's forecast of about 3 3/4, my interpretation is really quite different. I mean, I think we need to have the slowdown now. If we were going to have another year of 4.5% plus, then we'd be generating a bigger problem we'd have to deal with in 2009. So monetary policy, by being easy, can't make the economy grow above potential forever. Somebody needs to slow down, and I think in this case the U.S. is elected. I believe we're reasonably well positioned to do so because we need to adjust the residential investment sector, and quite frankly, with a household savings rate of 0, we need to see that savings rate go up, which means that consumer spending needs to rise less rapidly than income. Hopefully that adjustment coming gradually over a number of years. But somebody's consumption spending needs to grow less rapidly than their income.
And probably none of us would mind if some of the people who made large bonuses in the investment banking sector over the last few years did their share in that.
Except those who contribute to the Peterson Institute program.
We get 100% of their bonuses as it is, right? Mustafa.
General Motors. Arvind, you bring up a really interesting issue. I recall being in Cancun for the ministerial, which crashed because the African countries wanted compensation for the damage done to their economies by subsidized U.S. agricultural exports. Move forward just last month, the Indian finance minister and trade ministers blocked the new ag tax on grounds that they could not afford to lower their import tariffs. And yet the underlying circumstances have changed so dramatically that India is unilaterally removing it. And why is that not having an impact in Geneva on the ag negotiations?
Well, for one thing, it's too soon to tell. All these actions have literally happened, some of them in the last week and so on. So perhaps when the negotiators meet next, maybe some of this will transfer into negotiating positions at Doha. But having said that, remember that this is also having another perverse effect on the agricultural negotiations in the following sense, that one of the big things that Doha was going to deliver was agricultural liberalization, and one of the main protagonists on this were the agricultural exporters. But with them getting all that they want in terms of market access naturally, then correspondingly their incentive to really push strong on the negotiations also diminishes. So for that political economy reason, one could argue equally that the Doha round is going to be further hobbled by lack of interest and engagement, because one of the big sets of protagonists, the agricultural exporters, are going to get a lot of what they had asked for kind of naturally through the market. Of course, one has to be careful here, because although tariffs and things have come down, there is no guarantee that they will not be reversed. And so the WTO offers a mechanism to actually lock in these tariffs. So that's how the whole thing can play out.
We used to talk at the Fed about opportunistic disinflation. It might be time for opportunistic liberalization and inflation as we go. We're at 1 minute of 2, and I don't want to make one of you cram your question into 30 seconds, so I think we'll cut it off there with huge thanks to Arvind, to Morris, to Michael, and to all of you.